Some say if you throw a pebble into the water on one side of the ocean, it can create a tidal wave on the other. Inflation has become public enemy number one and a common threat that many major economies are struggling to defeat. This week, many reserve banks continue to hike rates to slay the monster. In the US, they're now at the highest they've been in 16 years.
The FOMC raised its policy interest rate by a quarter percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
The European Central Bank also raised rates from 3% to 3.25% with expectations of more hikes to come.
The inflation outlook continues to be too high and for too long. In light of the ongoing high inflation pressures, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. Our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target and will be kept at those levels for as long as necessary.
And Australia this week, in a decision many analysts didn't expect, raised the cash rate to 3.85%. This has led to slowing growth, with the EU and US barely avoiding a recession in the first quarter of 2023. And it's expected to hit consumers even harder, putting added pressure on household debts. To keep costs down as domestic demand falls, many private firms have begun cutting jobs. The US tech industry, for example, has lost over 185,000 employees since the start of this year.
The layoffs were tied, one, to the overstaffing, and two, to the impact of inflation and higher prices, which is causing less demand for PCs and consumer devices.
The Federal Reserve wants to cool the economy without sacrificing jobs. Only time will tell if it's successful. Emre Boz, TRT World.
Let's get more on this now with Daniel Gross, who joins us from Milan in Italy. He's a professor of practice and director at Bocconi University, and he's also the director of the Centre for European Policy Studies. Really good to have you with us, Professor. Clearly, the world's central bankers think that inflation is still uncomfortably high. They're raising interest rates, as we heard there. In the US, they're at a 16-year high right now. Can you tell us, are these measures still warranted, even though inflation is easing in the world's major economies?
The central banks in Europe and the US really don't have any choice, because inflation is a bit coming down, but it's coming down to levels which are still much too high, 5 to 6%, even stripping out inflation. And at this point, the central banks don't have a choice. They must increase rates, because if they want to have any chance of bringing inflation back down to the 2% target, they must be doing something.
When central banks like the US Federal Reserve began to raise interest rates to tame inflation last year, there was this fear that that would spark recessions in these economies, perhaps another global recession. It seems like those fears haven't come to fruition. Are we out of the woods yet in terms of that risk of a recession?
Paradoxically, this good news about the economy makes the task of central banks more difficult. Because if we now were closer to recession, there would be perhaps some unemployment, wages would increase less, inflation would be coming down. But here the central banks face a situation where they have increased rates, but the economy continues to power ahead, labor markets are very strong, and therefore also inflation continues to be strong. So for the time being, they don't really know what to do.
That's right. In fact, we've just got the latest US jobs report, which showed robust jobs growth in defiance of perhaps some other skeptics that were really observing these reports over the last few months. Does that mean the US Federal Reserve has managed to strike that balance between trying to tame inflation without impacting the economy too much?
That's what they're hoping. So that's why they have signaled that they might be stopping increasing rates. They wait for 6 months, cross their fingers, and hope that by that time the economy will have at least cooled down a little bit and inflation will be coming down sharply. But they don't really know whether that's going to be happening. It's a hope. And in Europe, we are even further away from this hope.
That's right. So in your view, when can we expect the inflation rate to come down to that 2 to 3% that many Western economies are really aiming for?
The true answer is that nobody really knows, least of all the central banks in a certain sense. The financial markets which trade on future inflation are actually quite sanguine. They assume that inflation will be back to around 2% in about 2 years. And that would be the ideal scenario. But I think at this point, we don't really know what mechanism would bring inflation back down to these very low levels. The central banks are hoping it will be happening. But for the time being, all we can do is wait.